This week sees the latest UK inflation data. It comes at a time where we've seen actually improved numbers when it came to manufacturing, industrial production, GDP, a raft of better than expected UK data points last week. And that really pushes back against the idea that we're going to be easing over the near term from the Bank of England because of inflation. Now, do we see further upside for inflation? Is this going to be a problem that continues to build and that really ties the hands of the Bank of England? Or will we start to see it turn around? Let's look into the data and gauge exactly how this inflation report is going to impact the likes of the pound and the likes of the FTSE 100. So first and foremost, we can see here, according to Trading Economics, the expectation is that we see higher inflation once again. The headline number up to 3.8, the core number up to 3.8 from 3.6 and 3.7 respectively. Now, if you look into the data on a monthly basis, it's not as bad as it might seem at first. And that's because both are expected to come in at 0.2%. And this really does highlight the question marks around whether people should focus on those big numbers, the headline numbers, or the monthly figures. I tend to look at the monthlies. I think essentially taking a series of monthlies together to gauge exactly whether inflation sort of gaining traction, losing traction is much more interesting than just looking at that big annual figure. And you can see here, we're expecting to see a decline on both monthly figures, yet a rise in terms of both annual figures, which highlights the base effects coming into play as we see figures from a year ago stripped out and replaced with new, more relevant numbers. Now, of course, we've seen a significant bump in inflation recently. That's why the UK has the highest inflation rate of any G7 nation. But you can see here that the jump in terms of GDP that we saw last time around, 0.4 for the month of June, has eased concerns about, or concerns, calls for the Bank of England to step in swiftly. Of course, they cut recently. There's a expectation, and we're not going to see one for a bit now. And in part, that's because we saw the Bank of England members on the fence. It was 4-4-1. The split vote ultimately came again, and we saw the rate cut. But markets are certainly very hesitant to call for additional cuts where you're seeing inflation on the rise and you're seeing GDP now holding up relatively well. Maybe the UK economy isn't too bad. And maybe it's the case that the Bank of England, whose core remit is to keep inflation under control, need to focus on that job in hand. In terms of the breakdown here for the inflation numbers, you can see here that the core and headline numbers are in the mid to high threes. You get 3.7 for the core, 3.6 for the headline CPI. Now, remember I was talking to you about the fact that the monthly figures are more important than the annual figures. Well, we're talking about base effects. Let's see exactly how that's playing out. Why do we see lower monthly gauges and higher annual figures? Well, it's because if we look here, we're looking at July coming into play. So what happened last time around, last July? Well, you can see that the last July figures were negative when it came to the CPI number and marginally, very marginally positive when it came to the core figure. That means the 0.2 number would be above both of those, right? Above the headline number, which last July was negative, and marginally above the core figure, which looks like something like 0.1, right? So essentially, that explains it away. You're dropping out very low figures from last year. You're replacing it with pretty respectable, decent enough numbers, but that still drives upside for the year-on-year figures. So from that same token, let's look at what could happen down the line. Well, you can see in August from last year, in actual fact, it's substantially higher numbers. So there's a good chance if we see another, say, 0.2 next month around, we see the opposite happen. We see the headline numbers start to come down. Now, September, it gets troublesome because you're once again in the position where, and unless you see pretty much non-existent inflation, it's going to rise again. And then October, you see even higher numbers than August. And so they come back down again. So, you know, October, November, it's a similar kind of thing. It's almost like on, off, on, off. And it feels like we're likely to see in terms of UK inflation, this rise and fall over the course of the next 6 months, where it pulls back. People start to say, oh, it's the top for inflation. Then it rises again. Then people say, oh, inflation is a problem again. The fact of the matter is, if you average out those months from last year, July, August, September, October, November, they rotate around that sort of 0.2 mark. So by and large, the average is something like 0.2. So if we're hitting 0.2s every month, then it's likely we're just going to stay steady. And so essentially what I'm saying here is we're going to stay at the mid sort of threes, so 3.5 kind of area. We're going to stay there for quite a while, I reckon. Certainly until next year, because ultimately the crux of the matter is the inflation problem really has reared its head this year. Look at the February, March and April figures. Once those get stripped out, you can see massive disinflation. But the caveat here is that much of that April figure really came down to a number of different changes when it came to the price cap on energy, when it came to some of the new policies implemented by the UK government. So whether some of that is seasonal and we see it happen again, and then we see a strong April number, or whether we don't because those policies aren't happening every single year. Some of it might not. But certainly when we see the real disinflation, it's going to be next year. When we see the flatlining inflation, that's going to happen this year. So quite what the market reaction is this time around, well, remains to be seen. But certainly I would say focus on the monthlies. It's not a problem as long as we're seeing 0.2s, 0.1s. Those kind of figures are fine. The odd 0.3. If we see 0.4s, 0.5s, that's when it's really problematic. And not only are we going to go horizontal in terms of the mid threes, in actual fact, we start heading towards the fours. But you can see here, look at the bottom, look at the 9-month annualized, right? So we're annualizing out to be in the fours soon enough, right? But this is heavily weighting all of the nearer term stuff, which I've already said February, March, April is pretty chunky. Now, a different way of doing it is if you look at that bottom one, see, I've just switched the bottom. So that is a 2-month annualized. Why 2 month? Well, because that April figure is undoubtedly skewing this massively, both headline and core above 1%. So let's look, if you take that away and say that's policy related, if you take that away and look at what's happening in terms of May and June. So since then, well, in actual fact, it's been relatively reasonable. It points towards a return back down to 3% for CPI. And so where are we going from here? We're going sideways, but at least over the past couple of months, we have been on a trajectory that points towards a potential move back down to 3% and below. So if we see a 0.2, then it's going to even reiterate that further. The 3-month annualized is going to get below that 3% mark. And you can say we're on a decent healthy trajectory. Now, notably, if we're looking at, say, so let's look at, say, the pound, and we can see the relationship between yields, borrowing costs in the UK, gilts, and the pound. And what we have seen here is that we're seeing relatively close correlation here, in particular the 10-year with cable, but it's all of them really. They're sort of at different scales here, depending on where they are in terms of percentage-wise for the 1-year, 5-year, 10-year. But essentially, what you're seeing here in terms of higher yields, if we see higher inflation numbers, that is likely to drive yields higher, in particular on the short end of the curve. So the shorter numbers, the 1 years, the 2 years, things like that, right? So if we see a strong number coming out this time around in terms of UK CPI, so higher than 0.2, particularly on the monthlies, then that could drive the likes of cable upwards from here. In terms of the outlook for the Bank of England, this is the outlook as things stand. No move in September, no move in November, and a 50-50 chance of a move by December. Beyond that, you can see that by and large, markets expect maybe 1 rate cut for the next year. So there's like a very low expectation of the Bank of England actually doing anything over the near term. We really need to see things sort of kicking on from here. I think it doesn't make much sense because inflation is going to come down meaningfully next year. I think we should expect significant amount more easing next year. And certainly if we see 0.2s and things like that, then maybe that feeds into that narrative around the sort of looser monetary policy once it comes to 2026. I can't believe we're talking about 2026 already. But nonetheless, over the near term, yeah, I agree. Like we're talking about 1 rate cut by year end. Look, we're going nowhere in terms of inflation. We're mid threes in a best case scenario. If we see strong inflation data, then yes, soon enough we could hit the 4s. In terms of the charts, let's just jump onto it. First and foremost, this is the FTSE 100. We can see that price action has started to find some support at key a key horizontal level you can see here, which is 91.25. That is the low that we have. So we've got these lows around here as well. And we've got this low back here. And we've got the low back. It's a great level alert. Here we go. So we'll put it all the way back down to here. So this is 91.24. So you've got this sort of zone of support, which time and time again has been respected. It has been key turning points for the market. The bulls are starting to rebound once again here. So near term, yes, we could see a little bit more support coming into play. Crucially, we'd need to see a break through resistance here to point towards a wider rally coming into play here for the FTSE 100. This is the 1 hour. So let's just look at the wider context. This is the 4 hour chart. So very clearly a bullish trend in play. We've sort of seen this sideways horizontal price action. We broke up through resistance and then we've come back into the middle of that. So we're now coming back into that support once again. Do we now leverage this to then push upwards and extend that breakout from consolidation? Potentially. But if we do break the support level, then you're going to be looking out for, this down here, right? You'd have to note the fact that ultimately we still are within an uptrend. Let me just get that on. It's probably not the best way of doing it. Let's grab these lows here. Okay. So at the moment, we're around this trend line support as well. So ultimately, I see this as that wider creation of lower highs, so higher highs, higher lows. Yes, we've got this key support level at the moment, but if we break it, we'll be looking at this essentially as a retracement here, and therefore you'd be looking at 76.4, which would be, it's not absolutely perfectly drawn on, there we go, which would be at 9111 support. So unless we break the 9075, I see this current pullback as a potential area where the bulls will likely come back into play soon enough. And in particular, if we see weak inflation data coming out, that'll be notable. Then we're talking about the pound. And so the pound has recently, and we've been talking about the potential resurgence in the euro against the pound, but the pound started to push back. And the reasoning for it is this, right? So if you're looking at the ratios between different yields, right? What we've seen is sharp downside in terms of European sort of Eurozone yields because we're seeing rate cuts, but strong yields in the UK, right? And so whilst the ECB has already cut rates, and whilst the Bank of England is yet to cut rates by any significant degree, yes, their rates are lower, but the market movements react to the relative movement in those rates. So if the ECB have already cut rates, the Bank of England have still got lots yet to do. Once the Bank of England start getting into that process, and once the ECB end their process, the relative movement benefits the pound over the euro. And therefore, that means that we're talking about the possibility that we're going to be seeing, the flip side, it would benefit the euro over the pound. So then you'd be talking about the potential for a resurgence for euro sterling. So this is something that we've been playing and talking about a lot recently. And that was all fine until we started to see inflation sort of becoming quite problematic in the UK. And then suddenly the idea that we're moving into a phase where the Bank of England is going to be really active starts to kind of fall flat on its face. And so that's why this inflation data is important, because if we do see something that's relatively weak coming out, then it starts to build that picture once again that we're going to see euro sterling strength coming into play. But that's not the case at the moment. We, of course, still have the possibility and likeliness that the UK inflation numbers are going to be flat for quite a while. We've come into resistance, started to roll over from here. And therefore, I wouldn't be surprised to see further downside to come. Let's look at it on the 4 hour chart. We can see that we've come into this zone of support and actually broken tentatively through that support level. We've also got this level here. So it's around about 0.86. So this to me is a very clear potential double top formation. If we break the 0.86 support level, it points towards a wider pullback coming into play. Does that mean it's the end of this bullish resurgence? No, far from it. Like I said, the basis is there for us to do more in the future in terms of the bulls. But as you can see here, wide swings here for euro sterling. If we break support here, then it looks like we're coming into another part of this move. We don't necessarily know exactly where that pullback would come into, but we'd be looking at our fibs and saying, potentially into the sort of 0.85 kind of area. So the key to that is whether we hold up at support once again or not. If we do, then we can rebound and retrace part of this move here more towards a sort of 0.869 kind of area. But if not, If we full-term break through support here, then we'd be looking for a potential break back down into this deeper zone. A lot of it comes down to how the inflation's looking. Of course, the headline annual inflation number looks like it's going to be coming in strong. If we do see that, then the possibility of a break lower is there. But of course, we are noting the monthly figures. If they're at 0.2, I don't necessarily think it's too problematic. It's not like skewing off course and suddenly giving us another warning sign. But if we do see a 0.3, 0.4 on the monthly figures, we could break that support level and start to see that pullback coming into play. But essentially, yes, I think markets will have to contend and deal with the fact that from here, we're not necessarily going anywhere in terms of UK inflation. It's going to stay in the mid threes. But even if we break through support, we'd be looking to come into this kind of zone and potentially then start to see the bulls building a case once again, that kind of thing, right? So let's see how it plays out. It really depends on what the inflation data comes out as, and it depends if we break through support. But yeah, I do see this performing well, euro sterling. I'm just aware of the fact that the inflation data over recent months means that the trajectory for UK rates could be a slower affair. And if it is, then a little bit more of this consolidation or retracement could be in play for euro sterling. I hope that's been useful. Make sure to like, subscribe, and follow for more. My name's Josh Mahony, Chief Market Analyst at Scope Markets. Thanks a lot. Have a great day.